Well, guys, thanks for joining us today. I'm going to go ahead and get this thing started. We have a great group of people here. We've got Randy. Randy, why don't you introduce yourself? Tell everybody what you do. Give them an idea of what you want to be. How is coronavirus impacting your business?
Okay. Hi, everyone. I'm Randy Newman. I'm from Total Lender Solutions. We are an independent trustee, so we handle foreclosures for lenders, non-institutional, institutional, and private lenders throughout all of California, Arizona, Nevada, and Texas. Right now, 2 weeks ago, I thought I had zero impact on my business, and now with everything going on and moratoria all over the place, and closure of courthouses and local public places, we are essentially closed for a couple of months, where we're not going to be able to do a whole lot of business going forward. So this has been quite impactful in unexpected ways.
Okay. And what are you seeing from the lender side of the community? Because you're directly interacting with both hard money lenders and institutional lenders. I mean, how are they reacting to this?
Very cautiously. Everyone, there's a question as to real estate valuation right now. And I think there are a lot of lenders who are very skittish about making any loans right now on the origination side. And because we just don't know where the valuation is going to be. The good news is this isn't a financial crisis yet. So we really shouldn't have the same sort of downturn that we had last time, around 12 years ago.
Right. Sam, tell us a little bit about yourself.
My name is Sam Brotman. I'm with Brotman Law here in San Diego. So we help clients through tax crises and help businesses save a bunch of money on their taxes. So this has been very transformative for our practice because we deal with businesses and individuals who are naturally in crisis already. And this whole process has really accelerated things. In the first 2 weeks of this, I think we lost 8 businesses, and we've been constantly putting out fires with client issues. Both whom don't have the ability to pay their taxes, and even those that did have the ability to pay their taxes, and there's been a change in circumstances. So there's been a lot of craziness that has surrounded the last few weeks. On the good news front, this is a very unprecedented situation with the state and local governments and the tax collection agencies. And it has essentially created a giant opportunity to resolve issues and for planning purposes. The planning opportunities that have come out of this situation are just tremendous. And so while things are in a relative state of quarantine, there's a really good opportunity here for people to optimize their situation and make the best out of it. But the last time the government was shut down, this is the federal government, was during the furlough at the beginning part of last year. And just a month-long shutdown with the IRS put them behind 18 months. So for something like this that is as unprecedented on an IRS and a state level, it's also very difficult to say what the impact is going to be, not just on enforcement, but, for example, the feds have, put out this July 15th deadline for people to file. And as of right now, the IRS is operating on a skeleton crew. So there's very little support if you call in. Basically, the call center operations are completely disabled. There are still some people answering the phone, but for most of the general helplines that you would go through, that's disabled. So there are challenges associated with this. And I for one, am not realistic that the government is going to be able to follow through with this July 15th deadline. And even if they do, it's going to be a giant mess. The other part of this, just briefly, is from a tax perspective, nobody is forgiving taxes this year. We're just simply deferring it. And in situations where we see this in our practice, what happens is just people get more and more behind the 8 ball. So this should be a good discussion, and look forward to talking to all of you about it. So,
great. John?
Yeah, my name is, first of all, thank you, AJ, for including me in this webinar. My name is John Fleming, Legacy Receiverships and Legacy Asset Advisors. I've been involved in commercial real estate finance and workout of commercial real estate troubled assets since the early 1990s. And my business practice has been, for the last 10 or 12 years, has been largely in and around assisting owners of real estate assets and their financing and maximizing their real estate valuation. And in the receivership side of the practice, it's largely in the workout side. It's where there's troubles with the property, where there may be a need for foreclosure, or a receiver to step in and basically take control of the property and to resolve whatever issues that there may be during a foreclosure process. Over the last couple of weeks, I've been speaking to a lot of hotel owners who are substantially impacted. I can't tell you the number of hotel owners are saying, we're shut down, many of our hotels, or we have 5 or 10 or 15% occupancies right now, laying off mass number of employees. I think that there's going to be a lot of pain felt in the hospitality industry, the restaurant industry, leisure and travel. We all know that nobody's flying anymore, but that there will be an extended, although the coronavirus hopefully will no longer be an issue health-wise as quickly as possible, but I think the economic and the financial reverberations through the economy and through the lives of many, many people will be impacted for months to come. And we could only speculate at how long that's going to be, but the effect on property ownership, tenants' ability to pay the rent, landlords and owners of property being able to pay their debt service and their mortgages. I know Sean was going to be on the call as a banker, but many lenders today are going through their portfolio, talking to all their borrowers, trying to accommodate and provide forbearance in whatever way they can to, give them accommodation. But I think that the next 90 to 120 days will be the accommodation and forbearance period. After that, then we'll see where the potential defaults and foreclosures will occur. And I know Randy will have some comments about that later.
Okay, I am trying to get Sean into this webinar. I don't know why he's not there. While I'm talking, John, you mentioned that you might be able to, he might be able to put in the code. Can you email that to Sean while I'm going? Because I'm not sure. Like, I think the invite that you get is different than what I get. So hopefully he might be able to do that. So I appreciate that. I'm Ajay Gupta. I put this together, so I'm kind of at the crux of all these guys. I'm a certified bankruptcy specialist. My practice focuses on insolvency and real estate litigation matters. I represent both creditors and debtors in this, which is a very, very crazy time. So we do some landlord-tenant stuff. We dabble in a lot of different areas, and we are seeing. I will say that the first group of calls that I've been getting, at least the ones that are retaining us right now, are really focused on people that have businesses that may have failed prior to the coronavirus. So they're businesses that had their debt to income ratios likely did not support long-term effective reorganizations. And the coronavirus is just the straw that broke the camel's back, to use a phrase that I used earlier today. But the longer term calls that I'm getting, and obviously we're going to talk a little bit more about this, are people that are completely out of business. From my chair, I haven't gotten the call from the hotel owners yet, but I have gotten the calls from landlords trying to do workouts with tenants, Same thing with, I would say the tenant side of things have been a little bit more muted, but I think that's in part due to some of the other things that have been going on. But the landlord tenant stuff, and the people that are hardest hit right now, the retailers and the restaurateurs, those guys are completely shut down, and granted, what I'm seeing is they can actually scale pretty well. With the exception, of course, being debt service and rent. Those are the things that they cannot scale down on. And so that's the danger for them is without any income, they're virtually getting none. There may not be room for them to scale into something. And so there really are looking to some of these SBA funds that may be available to try and help bail them out as a first measure. And if not, they're looking at different options in bankruptcy or in workout solutions. So that's what we're seeing here, at least on the front line so far. And then we can go from there. And, that's what we're seeing. So let's see here. I know I put together an agenda for this, but I wanted to see what happened to my poll. Do you guys have that poll that I threw out there? What are people interested in seeing? Polls. Oh, there it is. Okay, cool. So not a lot of you guys voted, but I just wanted to see. So it's like landlord, tenant, and foreclosure and banking issues are kind of running up the big one, the big areas. So, why don't we start it off with John? If you could talk a little bit about what you're seeing and what you think is going to be happening here over the next 2 to 3 months in that landlord tenant issue. And, I'm happy to chime in on some of the limits and the things that we're seeing on the legal side of things for landlord tenant issues. Why don't you lead us off here?
Yeah, absolutely. In and around landlord tenant, and I think what you're asking about is multifamily rental for the most part, or are you thinking retail tenancy?
I'm thinking all the above, to be honest with you. Like I think both commercial and residential, because you get to see both sides of these things. So.
Absolutely. And I think that you're going to see landlords really need to be as discerning as possible to make a determination as to whether they provide accommodation to the tenants. And obviously you don't want to lose a mass amount of tenants in your property, but if there are tenants that you determine are impacted by the COVID, by the virus, and they've lost their jobs, you certainly want to do what you can to keep them in the property, because if it's a retail property, as an example, and you lose a restaurant operator that has been in the business for the last 10 or 15 years, how long is it going to take you to replace that tenant after this is all said and done? It could take you a year to replace that tenant, whereas if you provide a little bit longer forbearance and accommodation on rent that's due, then that may keep them around long enough to be able to get them back up and operating. When it comes to multifamily rentals, it's a little bit different. You want to evaluate the marketplace, and clearly here in San Diego and San Diego County is a very tight multifamily rental market, and it has been tight. So if you lose some tenants, would it be a short period of time to replace them or a longer period of time? You really have to determine the location. Some may be a little bit more insulated from the potential impact of tenant loss. If we were to segregate the different levels of quality and categories of multifamily properties, I think that the higher end level, say A quality downtown high-rise multifamily with the highest level per square foot rent will likely be greatly impacted, because people will be looking to cut costs and perhaps move to a lower cost, lower scale multifamily property. So those are the sorts of things that landlords need to evaluate to determine whether or not they should just boldly evict their tenant or at least not provide more accommodation to the tenant to help them out through this period.
Looks like we got Sean in.
I'm in.
All right. Great. So So I want to take this as an opportunity to go through kind of some of the more recent legislation or executive orders that have been passed on the issue of landlord-tenant rules. So, and I believe it was on the 15th, San Diego passed an ordinance essentially saying all evictions, and the terms of art are that are related to COVID-19, I think, for non-payment related to COVID-19. And therein lies kind of the nuance of that particular question is, you know, and we were talking earlier, it's virtually impossible not to get something that's related, a non-payment that you can't claim to be related to COVID-19. I mean, it's touched every single person in this room and probably every single person in the country. So, so it's a very broad thing. And so that goes through May 31st. I mean, that's all of April, all of May. So, you know, theoretically on June 1st, you know, the total amount of rent is then effectively due, or you can start the eviction process unless a new rule comes in. 2 days after San Diego passed their ordinance, the state of California passed it across the state, but the state of California is only specific to residential properties. So if you are a commercial tenant and you're in that position, there's several things that need to happen. And this is where you need to be mindful, because the San Diego ordinance requires you to take certain steps. You have to write a letter to your landlord informing them that the non-payment is due to COVID-19. That has to be before your first month's rent is due. And so if you don't follow kind of the formulaic approach that they have, then theoretically, even as a commercial tenant, you are going to be subject to eviction in San Diego County. So those are the broad strokes that we're seeing on the legislative front for that. So, and obviously, if you've got questions about that, then you can check with Google. That was my joke, but didn't go over as well as I would have expected. We don't have a laugh track here, do we? So just check to see if you guys are paying attention. But I did have a question for you. And how are landlords, John, taking the issue of personal guarantees? I mean, what are they doing, and how are they reacting to it? And how much credence are they putting into that?
Well, I have a student housing property on the edge of San Diego State. Students, 100% of the students or 100% of the tenants are students. And we're holding that if they default on their rent and, you know, they're there for their education, that we're going to hold them to the guarantees. Now, clearly, we're going to have to abide by the eviction rules that are stipulated by the city, but we're not going to just let them out of their lease because they don't feel like paying rent anymore because they can't attend classes. So,
especially if they happen to be watching this webinar, right?
Exactly. I'm hoping they're not. But we will hold them to their guarantees. We will ultimately pursue the guarantees and get a judgment from them. But again, we'll want to work with them to stay in the property. And if they need a deferral on rent during this period, we'll work out some sort of an accommodation until things get resolved. But we're not just going to walk away and say, oh, your guarantees aren't worth it or worth anything.
So, I mean, from my chair, you know, when I see these things, I'm in the commercial context, not the residential context, but, you know, in the commercial context, I'm always looking at a couple of things. Like the first thing is how strong is a personal guarantee? You know, many entrepreneurs, the personal guarantee is only worth as much as the business, and if the business fails, then the guarantee fails. And so when I'm evaluating the options for the lease, I'm trying to evaluate the strength of the guarantee on both sides. And I'm not just talking about this from the landlord side. I'm talking about this from the tenant side. But sorry, I guess I'll put my hand down with that. But the other thing that I'm thinking about, I was going somewhere with this. The other thing that I'm thinking about is the value of the lease itself, right? And your average commercial lease is going to be somewhere between 5 and 20 years. And, you know, with options and all of that stuff. And a lot of times, by the time you enter into the lease and you're evaluating terminating the lease may have garnered significant value. Like, I mean, they might be leasing at $2 a square foot in an area that now is commonly sold at $4 a square foot. And there's almost this opportunity from a landlord side to take possession of a property that has a better asset value than it is in its current form. Are you seeing any of that? Any of those types of opportunistic movements or thought process on the landlord side?
No, I haven't. Although you're right, a longer-term lease that was signed 15 years ago, or maybe during the last recession, and the current market lease rates are well above that level, then certainly there is value in that lease, and you may not need to rely so much on a personal guarantee on that, but certainly you have to evaluate the quality of the financial strength and the quality of the assets behind the guarantee to be able to utilize it as an enforcement tool for the obligation of the lease.
And from the landlord side, and I know this is obviously going to be a case-by-case basis, but I mean, at what point is that lease liability going to translate into non-payment of, again, from the commercial and the residential side, into non-payment on debt service? How long do you think, you know, is it 3 months? Is it 6 months? Is it 12 months? What are you seeing on that end?
Well, it's really going to be hard to say, AJ, because it's going to depend on the property, but I'm going to speculate that it's going to be a 3 to 5 month time frame to really see whether or not that tenant's going to be able to survive this. And
you mean the landlord?
What's that?
We're talking about the landlord itself. I'm trying to figure out how many months of vacancy is it? When are we actually start seeing them defaulting on mortgages? The landlords defaulting on mortgages. I mean, is that a 6 month window, or is that a 12-month window, or what do you see?
It could be immediately, and Randy may be able to speak to that right now. Is that there are likely defaults on commercial leases right now as a result of the impact on this. But again, we're going to be seeing a moratorium on legal action almost across the board until whatever accommodation and forbearance and financial stimulus from the government flows through the financial system, till you really determine whether or not that tenant or that property owner is going to be able to survive and keep paying the debt service. So it might be immediately foreclosure, and it might be a year, AJ. It really depends on the property. It depends on the location, the market, and the quality of the tenancy. And maybe Randy can speak to that too.
So that kind of brings us to the next topic that we have is foreclosure and banking matters. So Randy, do you want to jump in there and let us know what you're seeing there?
Well, for right now, AJ, as I said earlier, there's no official moratorium in California as far as stopping foreclosures directly. The large banks, Wells, Bank of America, Chase, they come to an agreement with the state that they're not going to prosecute any foreclosures for the next 60 days. And they've done that as an internal decision. That they're not going to, and I'm sorry, not Bank of America. Bank of America only agreed to 30 days. The other ones agreed to, it's either 60 or 90 days.
My understanding that was just residential, right?
No, that is what they agreed to. They didn't specify whether it was residential or commercial.
Oh, that's across the board then.
That was an across the board, because the effects of this are nothing like anybody's seen yet, and they really don't know where this is going to end up. There are going to be businesses that are going to come out of this much stronger. And I know a handful of businesses, friends of mine, that the day after all this hit, they're out of business because they're in either event marketing, they're in hospitality, all these industries that got hit out of the blue. You've got industries where, as John was saying, you've got people who were teetering on the edge before, and now this just truly pushed them over. So is this related to COVID? Yes and no, because, you know, they were really in trouble before. Their debt to income ratio wasn't good to begin with. They were just getting through, and now this is just pushing them over. So I think, you know, from a bankruptcy perspective, you are going to get incredibly busy. Foreclosures, I don't think are really going to pick up for months and months. for a couple of reasons. Even, you know, in Nevada, for instance, on Sunday, the governor put an executive order out stopping all foreclosures in the state, all evictions in the state until 15 days after the state of emergency is lifted. So they didn't even put a tentative end date on it because they don't know how long this is going to last. California, the executive order, it was a request that people follow this. They left it to each county whether or not to curtail evictions. So, you know, for a whole host of other reasons, such as prohibition against large crowds gathering. Well, what happens if we have a foreclosure sale? You know, if more than 10 people show up, technically I can't hold the auction because now I'm in violation of the law. Oftentimes, believe it or not, much fewer than 10 people show up to any particular auction, but there are times we get more, so you've got to take that into consideration. If we foreclose, now the courts are closed because, and just as you were saying with the evictions earlier, there's that moratorium on evictions, but courthouses are closing individually, county by county. Up in the Bay Area, there are 7 counties which are essentially closed. We can't record things in the county recorder's office. Well, that essentially stops my foreclosure. We can't, the lenders, the successful bidders can't evict people following the foreclosure. Why would you want to own a piece of property that someone is in possession of that you can't get them out of? So you're accruing liability without any of the benefit and no resource to get you out. So it's going to be, for us, it's going to be an interesting dynamic for the next several months. We're really expecting things to slow down. We're starting foreclosures because we're starting clocks running, but we're not going to be able to finish things for quite some time.
So just real quick, I mean, and I know one of these questions is talking about what about kind of some of the outside counties, Vista, San Marcos. I think Ann Grimes mentioned that as a question, and you guys feel free to chime in on that. But you know, all of these areas outside of San Diego are going to fall under the state guidelines or the state restrictions on evictions. So just so you know that, and just to cap that off is and I believe this was Friday, if I'm not mistaken, but no, it was the 17th. The state issued a moratorium on evictions completely, and then Friday they issued. I guess the governor or the state of California made a deal with, I think it was, you know, the major 6 banks, and including U.S. Bank was on that list, Sean. So, but the major 6 banks, and as well as about 200 other smaller local credit unions and institutions, to stay all of the evictions. And I have a blog article on my website that I'm happy to share with you guys that directs you to links in terms of how you can help how you can find out if your bank is one of those. But that leads me to a question, and Randy, what are you seeing in terms of default interest rates? Because on these commercial loans, that's the call that I'm getting is if I miss my payment, is that going to trigger my default interest rate, which is oftentimes somewhere between, you know, if you're at 6% on your mortgage or your payment, a default interest rate could kick you as high as up to 18%. And for many of these people, that's a death spiral. So, I mean, that I don't believe that was covered in the agreement. What are you seeing from a lender's side in terms of charging default interest rates as a result of missed payments?
Well, what they had agreed to was waiving late charges. Typically in consumer loans, there are no default interest rates, especially for owner-occupied properties. So it's the late charge and any costs and fees that are usually collection costs that get added on. So those in that agreement have been waived for the next 60 days or the period of time that they had agreed to do it. On the commercial side, on the business purpose loans, the default interest ranges anywhere from about 5 or 6% above the nominal interest rate to, I've seen maximum of about 24%. Right now, you know, we're not a law firm, we don't give legal advice, but as our clients are calling us, we're suggesting to them that they waive those things for right now. in order to work out. If you've got a borrower who's been consistently having difficulties before, this isn't anything that's causing them grief. It may be a bar to them eventually recovering the property entirely, but there were issues before, and in that case, you've got to really determine from your relationship with the borrower what to do. For most other people, we're really asking them, and even as far as the foreclosure sales, we're suggesting to our clients, we don't want to foreclose for the next couple of weeks. We don't want to conduct any sales going on, and we don't want to get to the point. So can we have permission to, delay things? With no exception, everyone's agreed to do that for a couple of weeks initially, just to see what's going on and maintain the status quo. You've got restrictions on access to courts. My understanding is the bankruptcy courts are now only accepting electronic filing, which pretty much stops anybody from doing it in pro per, for the most part. So you're restricting people's access to relief. I don't think it's fair that we go forward in the foreclosure arena at this point.
Okay. Yeah, that's interesting. Sam, talk to me about taxes.
Well, there's a lot of interesting things that are happening from a tax perspective. So first, the IRS has issued guidance that's sort of an effort to help people who are impacted by COVID-19. So the first thing they've done, obviously, is extend the filing deadline. It has extended, along with the filing deadline, the deadline to make estimated tax payments, the deadlines to make IRA contributions and things like that. Also, up until July 15th, they have extended, they've put a moratorium in place on any IRS collection activities. So I don't think they could file liens if they wanted to, given the county recorders, but there's no lien action, there's no collections action. So for people who are on installment agreements with the IRS and they default, there won't be an issue. Nobody's going to get levied at this period of time. And basically IRS collections has essentially shut itself down. That is also true in terms of negotiating a resolution. So one of the biggest challenges that we've had is for people who are on existing agreements and want to get off them, because there's nobody to release you from your agreement. FTB collections have also ceased. California has kind of followed suit on collections. They're not issuing levies or anything like that. The collections, not to get into the differences between the federal and the state, but the frontline collections people, as well as the complex account recovery unit, have kind of all been sent home. And so that is, that's been happening as well. As far as audits go, there's no in-person meetings, there's no field investigations. The IRS audit unit is still moving forward on existing cases. The IRS criminal division is supposedly moving forward, although I don't know what that means if they're not able to go out in the field and interview witnesses and do things like that. So in the criminal arena, we've had some of our cases get pushed forward. The government is banned from any sort of travel, so there haven't been any in-person meetings, but there's been some conference calls. They are trying to coordinate things, at least logistically. So if anybody out there is planning on committing a tax crime, there is still some measure of enforcement that it's out there. So I wouldn't recommend that you do that.
Good to know, Sam. Good to know.
Yeah.
Sam, Sean actually asked a question in the chat window that I'm curious about. Did the 1031 timelines exchange get pushed forward? Are you aware of anything?
I haven't seen anything that suggests the 1031 exchange timeline has been pushed forward yet. I don't know if there will be a relief provision with exchanges. There hasn't been one that has been proposed, but I haven't looked at that issue yet because it hasn't come up with us. So it's possible that there could be a delay on the 1031 side.
You mentioned earlier that you saw 8 businesses that went under already. I mean, after 2 weeks, you saw 8 businesses gone just like that. I mean,
Yep. We've had a lot of event planning businesses that have gone under immediately. We've had some restaurants that have folded. The problem with businesses, and because we deal with a lot of distressed businesses, businesses usually don't have more than about anywhere between 2 weeks to a month of cash flow. Probably surprise a lot of you, but there's not really core capital that we see a lot in terms of the businesses that we work with. Even the ones that are healthy and doing tax planning. Now, the individual owner may have resources individually. They may have retirement accounts, or they may have other assets that they can use to contribute to a struggling business, or they rely on debt service. But the problem with a lot of businesses is the safety net is basically non-existent. And the biggest mistake that we see business owners make is there are a lot of people who haven't gotten out in front of this. So there are businesses out there that are continuing to pay payroll and pay staffing for people that are just not working or who don't have a lot to do. So we saw this with a lot of restaurants, and as admirable as it is to try and keep people employed, the reality is it's all math. The businesses are the expenses that are getting paid, it has to come from somewhere. So what we see a lot of businesses overcommitting. We see a lot of businesses that are underestimating the impact that this is going to have on their business. Depending on how much news you read and what you believe, I think it's a very early estimate. We can probably see this going through the end of April. More conservatively, probably into May, maybe even in early June. So the impact of that is, although we've kind of gotten the first wave of people who are teetering on the edge, in the long term, particularly as everybody freezes, this problem is going to get a lot worse, because what's happening is a lot with the landlords, at least, there's moratoriums, and, people are telling their landlord, I can't pay you. And, there's not really much of a recourse right now on that level. But with vendors, everybody's kind of in the same boat. So staffing companies are getting hit because people are laying off direct hire people. People are scaling down essential services for their office, trying to break leases and things like that. So there's a lot of shedding of expenses, but some of these expenses aren't scalable, and it's systemic. Just today, we heard from a marketing company, that went under yesterday, and that has a domino effect across the industry. From a tax perspective, as I mentioned, the problem is when people get behind on their cash cycle, the first thing to go are payroll taxes. The second thing to go are sales taxes. So with the payroll taxes, there's at least some relief at the federal level. There's deferment of payroll taxes that basically is very generous, and you can defer half of your payroll taxes for this year until December 31st, and then you can defer half of it until next year. So there's some generous payroll tax provisions. There's payroll tax credits for those who retain employees that are impacted by coronavirus. So you've got some really good tax incentive on that. But the state in particular hasn't responded with corresponding provisions. So payroll taxes that are owed on the EDD level, payroll taxes that are owed, or sales taxes in particular, which gets particularly nasty for some businesses, there's no relief on those. And the issue with those taxes, as being in bankruptcy, is there's trust fund liability associated with that. So if a business is not properly accounting for sales and use taxes and or payroll taxes, they can extend liability to somebody on an individual level. So you need to be very careful that the money that you're counting when you're counting your shekels, so to speak, is actually your money, because anything that is considered a trust tax, anything that's an employee withholding, so the percentage of the payroll taxes that are associated with your employees, those monies are still out of bounds. And so even if you are deferring these, you have to still plan for the obligation when it actually comes down. So it's pretty gloomy out there in the tax world. They put these relief provisions in place, but it doesn't really take the pressure off. They're just sort of speed bumps to keep people from accelerating. So what we're predicting is going to happen, unfortunately, is as people can't make the July 15th deadline to file and pay, presumably they're going to move the extension deadline for filing, but the extension deadline is an extension to file. I haven't heard any corresponding relief for extensions to pay. So there will likely be some interest. They'll probably remove the penalties for this year because of reasonable cause. I would imagine the IRS would come out with something like that. But then you go into next April. What happens next April? Now you're suddenly 2 years behind on taxes. So what I'm predicting is this is sort of be a domino effect across, particularly with collection cases. And the problem with that is, particularly at the state level, the state interest and penalty rate is pretty egregious, particularly for liabilities.
18%.
Anybody who's owed money to the state of California knows those guys don't play fair. We were doing a calculation for an audit a couple months ago in the firm, and we calculated that between the examination side interest and the collection side interest, it was like 17%. So, I mean, it really is very high. So the prediction that we're making is there's going to be more and more people that are getting into trouble. So planning actually is at an all-time high. We've got a bunch of planning calls. There's a ton of business and cash planning you can do with respect to COVID. There's a number of the economic relief packages that are pretty generous. The payroll protection provision in particular is extremely tax beneficial. It basically is a gift of tax-free money. And if you leverage that appropriately, not only can you generate loan forgiveness, but you can generate sort of a massive tax deduction in the year in question, depending on how you utilize it. A lot of the economic recovery provisions, even though they come with corresponding obligations, if you can plan out a business's cash flow so that they're spending money where the SBA wants them to and they're retaining profitability, that profit that can be reutilized in the business or can be invested in other tax-deferred investments. So for the people who are kind of on the high end of this, there's lots of opportunity. There's lots of opportunity around asset acquisition and things like that. So, it's either feast or famine, so to speak, but it's been very interesting from a tax perspective.
Interesting. Well, it does actually segue us into Sean. And before we get there, I mean, and I know this is a really broad question, but if consumers are faced with these types of situations, how is it that you step in to help them?
So the important thing from a planning perspective, when you have a liability that you can't pay, or when you're standing on the edge of a business that you know is starting to go down, you want to try and get out ahead of it as early as possible. So making sure that you have the end in mind. And the end in mind, hopefully, is the business owner walking away from the situation, able to still sustain a reasonable quality of life. So you want to protect, obviously, the goal really is about protecting the business owner and their family, making sure that they're going to have some sort of sustainable cash flow, even with a failing business. And then with respect to the tax obligations, once we're protecting the business owner and family, or once we've shielded the business, and so that the business can continue to generate cash flow and keep going in situations where the business has gone under, then we kind of work the IRS and the state of California in the picture. So if you know that you're going to owe a liability ahead of time, or that you're not going to be able to make payroll taxes because you're trying to keep your business afloat, you can start planning for it now. And because of all the chaos that's going on in the state and federal governments, as I mentioned earlier, this is like the perfect time to play Let's Make a Deal. Because election, what's going to happen is you're going to get this massive surge of collection cases. And because in the government's infinite wisdom, it's not popular to fund the IRS is at a low time freeze in terms of resources. I mean, even before this crisis, they were struggling with frontline collections people. They were struggling with your normal examiners and collection agents. So the tidal wave of collection activity that's going to happen and the number of active cases that are out there with all these people that are going to owe, the burden that's going to place on the state and the feds at an administrative level is going to encourage the frontline people to try and turn cases. So there's going to be a lot less care associated with financial analysis. There's going to be a lot more focus on what can we do to resolve the case and resolve it quickly. So for people who had tax liabilities pre-crisis, or those who are accumulating liabilities, while you're having a period of down financials, start planning out the liabilities so that when you come out of this in, June, July, whatever, when the quarantine is lifted and whenever you feel like you're going to be able to go back to normal, you will have a good set of down financials to show collections and get out of this. It's a great opportunity. Correspondingly, on the flip side, they just gave away $2 trillion. Where do you think they're going to pay for that? So what you're going to see is, particularly on the state level, because California was cash strapped to begin with, there's going to be a huge surge in hiring for agents. And probably won't feel the effects of this until the end of the year. But my prediction going into next year is enforcement is going to be at an all-time high. Audits are going to be at an all-time high, because once people are healthy enough to recover from this, the state's going to take their money back. And California in particular, the system here is not geared towards taxpayers. There are very strict provisions in the California Constitution and within the tax procedure. There's not really an appropriate judicial check against the administrative tax agencies. And the problem with California in particular is you do get good people making good policy in Sacramento. But when you translate that across 33, 35, 40 district offices, you get different standards of enforcement, both in terms of examination, how audits are viewed, and in terms of collections. And the common critique that we get with our clients is, I just want to follow the rules, just somebody tell me what the hell they are. And California makes that really difficult because, we had situations pre-virus where you take two different cases in two different offices and we get two different results. And there's no consistency on the state level. So
I get a tax bill and I pay it. That's all I know, right? Like, I don't even ask anymore. I'm like, all right, fine, whatever.
So the problem with this is for those of us who are still here and standing after this, enforcement's going to go through the roof. So the other thing that needs to happen, which is, the unfortunate thing about the practice is, I feel like what's the character in Animal Farm that says that warns about the pigs? It's the same thing with tax compliance. Tax compliance doesn't cause an issue for people until they get a notice from the IRS that causes them to give an expletive. And the problem is with the increase in enforcement activity, they're going to squeeze compliance. So people who are out of compliance, and even if they didn't know that they were out of compliance, are just going to get hammered by this. And so really the focus is for businesses on a tax perspective is, how can I take as much advantage of this opportunity as possible so that I can increase my cash flow, so I can sustain my profitability, and so I can benefit from the tax perspective as much as possible. Two, how do I protect when the tidal wave comes for enforcement and collections? How do I get my nose clean? How do I stay clean? How do I stay off the radar? How can I protect my business? How can I make sure that my practices are in line with what the state is going to be asking for? And then three, if you do have a liability or you project some sort of crisis, get out in front of it. Over the summer, over the next few months, once the government opens back up, take advantage of the opportunity. For all the businesses that are sucking wind right now or who are failing, now is the best time to try and get a resolution package in place for the IRS, particularly with the feds, because the feds are going to be so apt to deal and just resolve cases. So that's really the best advice I can give the people on this webinar and for their clients is get out in front of this as quickly as possible.
So Ann asked another question here, and this is more directed at Randy and John. I don't know if you know the answer to this. Is it true that mortgage companies and banks are only doing forbearance for residential owner-occupied properties? Can they still foreclose on non-owner-occupied properties or deny forbearance? Are there any private investor-backed loans going to cooperate with this? Do you guys have any thoughts on that?
From what I've seen, commercial lenders still, enter into forbearances every day. The issue's really what's been formulated is as a result of COVID-19, and nobody has defined what that means. So does it mean I don't have any business tomorrow? Does it mean I'm temporarily out of my office? We don't have a definition of what's there. The lenders can enter into forbearances with anybody they want to. They're not required to ever enter into a forbearance. They've got, what they've agreed to do is come to the table. They're not going to go forward with foreclosures or evictions during this time, but it doesn't necessarily mean there's going to be a valid forbearance where they agree to tack the money on at the end. A friend of mine called her lender and they said, yeah, we'll give you 3 months, but all the money's due at the end of the 3 months. It really wasn't doing anything for her whatsoever except kicking the can down the road.
Yeah, maybe saving her credit a little bit. I mean, that's just about it,
and that's basically it. But, if she doesn't have the wherewithal to make the payments today, she's not going to have it in 3 months. She's also in the restaurant industry.
So I also know, in addition to the state of California, that Fannie and Freddie have issued some guidelines, and they're supposed to be issuing 6 to 12 months forbearances relatively easily. One of the challenges with Fannie and Freddie is nobody knows whether they have a Fannie or Freddie loan. So, and again, I put this in a blog article recently, which I'm happy to point you to. But there's actually a link on each of their websites to find out. The servicing agent isn't necessarily Fannie or Freddie, and the person on your deed of trust isn't Fannie or Freddie. So how do you know? But it's a large number of mortgages. I'm not aware that mortgage requirement, I'm pretty sure it does not stick to it's not limited to residential, and it's not limited to owner-occupied because, but there are strings that come with it. So if it is the case that you're taking a forbearance, then you're going to be limited in terms of your ability to evict based on COVID-19 as well. So, that's my understanding as well. So, I don't know if that helps or hurts or whatever it is, but that is definitely another option out there. So, segueing into options that are out there, the man of the hour. Let's go to Sean. Let's talk about some of these programs and the free money that Uncle Sam's given us.
Yeah, it's a pretty robust program. I don't know if they, the way they threw it together, this morning we were shaking our heads a little bit because Treasury put out a application, and the banks are the ones that have to take the applications, and we have to build the back office to accept electronic applications. So.
You're going to put us at the front of the line, right?
Yeah, well, that's why I sent you that information. The funny thing that shocked us this morning was they said the Treasury said we're gonna take applications on the 3rd, and the Treasury doesn't take applications. The banks have to take the applications. So, and they didn't give the banks a heads up that April 3rd was going to be the day. So,
Sean, are you ready for an absolute avalanche of applications that are going to come in over the next, couple of weeks?
Well, we're preparing it. I think we will be. The application is very simplistic. We have a back office that allows clients to apply for online for loans right now, and we're just going to switch it over so they could apply through the SBA through the same channel. But there's still a lot of questions. I know as far as documentation, I read the whole thing, and it's basically basing everything on tax returns, but I don't see anywhere where anybody's being asked to submit their tax returns with the application. So those numbers, a lot of businesses are looking at their internal financials of where those numbers are going to come from. But in my opinion, they're going to have to come from the tax return because that's the only way the government can track it. So they'll have to depend on those numbers, which isn't always easy. But they also said they were going to be able to fund next day. And I was telling my clients might want to take that with a grain of salt too. And this is all through the SBA, and they're just having the banks kind of help out. So for our clients, if they were approved through it, we do have the ability to ACH the funds into their account. So that'd be a little bit quicker. But if it was for a non-client, we don't have their account number. So that would have to go out in a different form, because you don't have to use your bank. There's only the certain amount of banks that are going to have the back office that's built for that, to be able to take, because nobody could take paper applications on something like this. It would just be insane. There's got to be computer models that have to figure out.
Let's back up. I mean, obviously there's a lot of local programs that are out there. And for those of you that didn't get the original invite that I sent out, I mean, TGG did an excellent webinar yesterday morning on this stuff. And I would, if you need the link, they've got it posted on YouTube. It's still not on their website, but it was on YouTube already. They really drilled down on a lot of different options, and they broke down the stimulus package in terms of small businesses and, the different types of loans. But as I understand it, Sean, there's basically two buckets right now. There's the emergency disaster relief fund, or something, the EIDL, right? And then there's the PPP. Can you explain the difference between those two?
I wish I could do a better job. We're totally 100% focused on the PPP right now.
Okay, and that's fair.
That's what they asked us. That's what they threw in overdrive. I'd done a little bit of research on the other one, but those were in place through the SBA. I don't think those would be able to provide funds in any really quick way at all, because those funds are usually for something like Katrina or something like that.
Yeah, that's my understanding as well, is that the EIDL is a larger sum of money, but it also would be a much longer process, and they're not forgivable. It's a loan. Whereas
it's also personally guaranteed, where the PPP is not personally guaranteed.
Correct.
They're doing a 30-year payout on them, but they're subject to credit check and everything else that's on there.
So the PPP, talk about that for a second. I know we all, Sam, you've researched this, I've researched this, but Sean, what are some of the benefits of the PPP?
Well, I think that the main benefits is keeping people employed, and doing so quickly so they don't get laid off and then have to get rehired. It's if they can fund it that quickly, they can keep those people employed. It also covers, their healthcare costs and other things associated with having employees, not just their salary per se.
So from a borrower's perspective, I understand that loan is also, it's forgivable. Is that correct?
That's what they're saying. It depends on what there's portions of it that are forgivable. Pretty much most of the payroll stuff is forgivable. If you're using it for other things, they can't guarantee that those will be forgivable. But the interest rate is 0.5%. So
what is it?
0.5.
0.5% annually?
Yep. Yeah, so it's they're being pretty generous, like I said, and they're trying to get the funds out real quick to keep people employed.
And then so it's limited to, I think, 2.5 times your average payroll over the last year. Is that right?
Right. They're basing it off of 2019. If you have a new business, I think they said you could go off the first 2 months of this year.
Okay.
But again, I don't know how they're going to track anything without
tax returns.
The tax returns.
Yeah, well, they can't track tax returns if they can't have a tax return for 2019 if you're not asking us to file until the end of the year. So, or sometime in July. So yeah, that'll definitely be interesting. So what other features are there of the PPP loan that are outstanding?
I mean, it's a pretty simplistic program. I mean, the debt forgiveness is amazing, but a lot of the things that we're getting, I'll give you some questions I'm getting back on it, because it's a pretty simplistic program. But you know, some as a tax standpoint, some owners pay themselves, some owners don't really pay themselves. So now can they lump those funds in as well? It's capped at $100,000, but if you have an owner that pays himself 160, you know, can they get 100? And from what I've read, which is there's not a lot of meat on the bone as far as the information is concerned, but that would be the case. So it's changing every day. Everybody's trying to build up this, figure out how to do it. I know all the banks are getting involved because they all have to figure out how to streamline this, because it's, you know, there has to be a back office component that can, you know, support that. So we're having meetings all the time.
Are you helping people fill this out, fill these things out, or is that something that your office does? Or
yeah, we're doing that. So we're helping people both with the actual application process and then in terms of the planning for some of the stuff.
have you gone into the formulas or any deeper? Have you figured out kind of? I know it's Friday, guys. I mean, this came out literally three business days ago, right? So, I mean, what are you seeing, at least preliminarily, when you start delving into some of these formulas?
The formula is actually pretty generous because it includes independent contractors and it includes other people that you can potentially label as independent contractors. The 19 to 20 formula is difficult for businesses that have been continually growing. So, for example, if you have a business pretty explosive growth in 19 and they're adding employees at the end of 19, you only get minimal credit for that. It's basically an average, but it's a pretty generous formula, and you know, we're encouraging clients to take advantage of it. For larger businesses, there are there's some regulations on whether or not they qualify as a small business under the provision. So you have to be careful with businesses either with certain revenue sizes.
Do you know what the revenue numbers are like? Do you have a ballpark on that?
It's varied across from industry. Let me see if I can share a table in the chat feature that kind of breaks down what a small business is. It's based on the your industry classification code, and so some industries are based on revenue dollar amounts, and some are based on the number of employees. So for larger businesses, you have to fall under that cap. But it's still, for those who qualify, it's an incredibly powerful program.
So who do you think is the best person to help businesses get through this application process? I mean, is that your CPA? Is that your attorney? Is that your accountant or your bookkeeper? Who is the best person based on what you're seeing?
I mean, really, there isn't a good answer. I would lean against the CPAs from that perspective because the CPAs are still engulfed in tax filings. If you've got a savvy bookkeeper, a bookkeeper can help you out. The way we've been handling it internally is we have two very talented paralegals who basically do nothing but financial analysis all day. So we've been outsourcing the work to our paralegals. The application process is actually fairly simple. We haven't seen the payroll protection application process, but based on the initial guidance we received, it doesn't seem to be fairly complicated. With any other loans that are being issued, the application process is more lengthy. So there's requests for tax transcripts. There's an explanation section. There's some other stuff. So what we do is usually get everything together. We'll have an attorney give it a gloss over as a review, particularly for clients who have more complicated situations, and then basically hand it to you ready-made. So it's been pretty good. We've tested it with a couple clients. We've obviously had a lot of interest given our target demographic, but it's worked pretty well, and we're revising the process as a firm, but it's going to be a substantial part of our core services, at least for a little bit. So in terms of helping everybody get it back on track. The other thing from a planning perspective is it's a good opportunity to sit there and do some planning work too, because there really are opportunities for people to take advantage of while you sit here and do this.
I know There was Lexi Lardner, one of our colleagues that works at Coastal Payroll. She was saying that she's working with her clients and even not people that aren't her clients, trying to assemble payroll data in a way that's going to be helpful for people. And so she's kind of trying to reach out and figure that out for her groups of people. Sean, what else do you think people want to know about these loans?
I don't think there's too much of a. If you have employees, I would definitely apply for it. I mean,
so all right. Let me ask you, like, is there a threshold need requirement? I guess is there a point where somebody who, like, what is the what type of hardship do you need to show in order to qualify for this?
You know, that's what is so bizarre about this. It's not really asking for a lot of that information. You know, normally there's an underwriting process with any of these things, but if you saw the application, I sent it, and you could send it on to anybody else, but you could fill that application out in 5 minutes, you know, if you have your tax return in front of you, and there's not asking they might change this, but from what I've seen, I have not seen them asking for. I mean, eventually they'll ask for maybe how many employees you laid off, but at this point, if you haven't laid anybody off, I don't see any restriction in that either.
And the turnaround time on this, they're talking about 24 to 48 hours. I mean, that's the published guideline right now for funding.
Yeah, I find that hard to believe, but.
By the way, sole proprietors and self-employed individuals are included in this too. So to the extent you have a sole proprietorship or single owner business that's dried up, you can qualify for some measure of relief.
That's interesting. Well, guys, I mean, we're at 5:07. I know I wanted to talk a little bit about some bankruptcy stuff, but I don't know if you, John, I know you got to check out here.
Yeah, I do.
I feel like I would just be rushing through this, and what I'll probably do is do another webinar. If anybody wants to talk to me about the new Chapter 5 bankruptcies, I mean, I'll do a 2-minute spiel on this. I mean, I think some of the hardest hit industries that I'm seeing are the retailers and the in the restaurant industry, and those are two industries in particular that are intimately tied to their lease. The lease itself is their business. Without a valid lease, they don't have a valid business. And one of the challenges that you're going to see in this arena as these negotiations between landlords and tenants fail, there's going to be, 3-day notice, 5-day notice, 7-day notice, whatever is called for in the lease or, under the law that are issued. California has a particularly harsh perspective on the termination of lease provisions. And so if that 5-day notice is issued or that 3-day notice is issued and it expires and it's valid, there's no mechanism in bankruptcy or otherwise to reinstate that lease. I mean, it's a very, very draconian provision of California law, and that's even in bankruptcy court. So what I think you're going to see from the landlord side and from the tenant side is people needing to race to the courthouse in order to save their leases, because come May 31st, these back rents are going to become due. And if they can't negotiate their way out of this box, there's going to be terminations of leases that are issued. And that termination, it mandates getting to the courthouse before the expiration of the notice period in order to preserve what is probably their most important asset, and that's their lease. Typically, they've got X amount of dollars invested in, whether that was directly through the landlord or through a loan that they've taken out. And without the lease, they have no business. And that's where the subchapter 5 comes into play. That was actually issued in February of this year. The subchapter 5 is really an access to a small business that never existed before. So, and I'll leave it at that. But if you have businesses, the most important asset is that lease, and it is extraordinarily easy for a landlord to take that lease or take that asset and basically convert it into their own. So it's funny because we just saw, the Cheesecake Factory just issued a notice that said we're not paying any leases for April across the country. This is going to be a problem. I mean, granted, there's no way the Cheesecake Factory would qualify for a Chapter 5, but Chapter 11 is around the corner. So I'll leave it at that. I see 3 questions on the Q&A. Let me see what that looks like. PPP. I'll see qualify for a PB at least. These are all from Susan, so I feel like I'm just going to call her and talk to them about it.
Yeah, Susan, you can call me tomorrow too, and I'm happy to talk to you about it. So
yeah. So and if you need anybody's contact information that's on this panel, just email me. I don't know if this thing's going to post automatically. It's my intent to mail out this this webinar to everybody, and once we kind of clean up some of the early and the later portions of this. But thanks everybody. Thanks everybody for participating in this. I really appreciate that. I think it was a great first try for me. It was a good experience, and I'm hoping to do more of these. So I appreciate you guys sticking with me in the first go around.
No, thanks AJ for putting this together. Thanks everybody for coming.
Thanks for having me.
Thanks everyone.
All right. Take care, guys.